I do think that the investment community is terrified by the unpredictable nature of the developments that have taken place, particularly the coronavirus. But I think there's also a bigger thing at play here, and that is that markets went into 2020 quite elevated, with valuations being very stretched. And so whether it was the virus or something else, I think it would have been a catalyst for a stock market correction, especially on the back of the extensive increase in value we saw in 2019. But certainly there does seem to be a lot of fear that has plagued the investment community. There is a lot of uncertainty. There's very few, if any, experts who know exactly what the outcome of the current virus will be and how it will be transmitted through our community. And we're all worried about it, and it's self-evident from what's happening in the stock market. Despite thinking that this is a sell-off we needed to have, there definitely are opportunities out there, we believe, mainly as a result of extreme dislocation in the stock market. There are sectors in the stock market which we think still look quite expensive, notwithstanding having fallen somewhat in 2020. But there are other sectors within the stock market that have been savagely dealt with. And from the perspective of a long-term shareholder who's happy to look through whatever may come in the next 6, 12 months, perhaps 2 years, I think there's a huge amount of opportunity to be had in these cyclically depressed sectors like energy, materials, perhaps retail, and far less opportunity in the more defensive healthcare names. Take, for example, the energy space. We've been saying for some time that we think the sector is quite cheap, and it's fallen 20 or more % in the last few days on the back of events which we certainly didn't predict and weren't part of our base case. But we do feel that some of these cyclically depressed sectors within the market operate in an environment which is simply not sustainable. And as soon as you overlay some sustainable assumptions, the valuations look very, very cheap. And I think for long-term investors, they represent excellent entry points. The oil price is simply too low to sustain production. And you don't have to look much further than the US onshore producers to make that quite clear. At $50, $55 a barrel oil, these companies were barely free cash positive. In fact, by our assessment, roughly half of them were still burning cash and not growing meaningfully. And so at $30, $35, $40 a barrel oil, it's simply unsustainable for these companies, and they themselves have huge amounts of debt and cannot carry on doing the production that the market has become accustomed to. And when you look at the US onshore as a single entity, so to speak, it compares quite favorably with the total output from Saudi Arabia. And it's quite possible that production from US onshore falls 2 or 3 million barrels per day, which in itself would be quite alarming to all those who fear or feel that surety of supply is very important, and it is for the oil market until such stage as we move to a carbon less intensive period. Woodside's our largest energy exposure in our portfolio, but we also have a reasonably large investment in Origin Energy, Oil Search, and also a very small Senegalese-focused oil company called FAR. And those are the only ones we own with direct exposure. And we also have started buying a reasonably decent amount of Worley Parsons, which, whilst not an oil company, I'd say roughly 50% of his business is generated from servicing the oil industry and providing engineering and consulting services to the oil and gas industry.